Good evening, everybody. Thank you for joining us for this quarterly update call for the Kotak Pre-IPO Opportunities Fund for the quarter ending March 2025. The format of the presentation will be as it was. I will run you through the overall fund update and then followed by individual companies. And then we will take the question and answers at the end of the session. Request you to keep populating the questions in the Q&A window through the presentation, and we'll get to them at the end of the presentation. As you're all aware, this is just a quick recap. This was a 2,000 crore fund raised in June of 2021. The final close of this fund was done in January of 2022. And the fund life is 5 years from the final close, so it's till January of 2027. We had drawn down capital of 1980 crores. Outstanding capital of this is about 1470 crores, and the value of that is about 1692 crores. We have about 11 crores of cash in the bank at this point of time. The multiple that you see of 1.18 on the invested capital, this is basis the valuations that we've done recently. We had from a third-party valuer, as you're aware. We conduct valuations once a year, and this has been done as of 31st of March. This reflects the most recent valuation marks of the portfolio. So the overall multiple on invested capital stands at 1.18, total value to paid-in capital at 1.1x, and about distributed value is about 0.24x of the capital that has been drawn down from our investors. Just previous slide. The fund in the last quarter distributed about 66 crores of capital and profits back to our investor. This is through exits that we've done in SMT, Swiggy, and Aadhaar. Those exits have resulted in the 66 crores, which has been distributed to our investors. The valuation, because this is the first quarter and this is the first time that you're seeing the updated valuation, we've split it up into a couple of slides. This slide covers the overall portfolio valuation of the unlisted portfolio. And as you can see, we've done the valuation comparison between the portfolio values as of December 23 and March 25. Of the 7 portfolios, unlisted portfolios that we have, we've seen a markup in 5 companies and a drop in valuation in 2 of those companies. And I'll go through each of these companies in some amount of detail. NSE, obviously, the business itself has grown by 16% on a year-on-year basis, coupled with the improvement in valuation multiples of the closest competitor. But the full year impact of the SEBI regulations was seen only in the Q4 of FY25, and the full year impact will now be seen in this FY26 calendar year. But from a valuation perspective, because of the overall growth, the valuation of NSE has improved to about 2.27x. Second company, we have Pine Labs. We've seen an improvement in valuation from 1.38 to 1.6x. This is backed by the fundamentals of the company, where the company has grown. EBITDA is on track to grow more than 100% year on year, and the company is on track to go file the DRHP and go public in India over the next few quarters. And this is a reflection of the valuation increases, a reflection of that itself. SMT, there's a small increase from 1.35 to 1.41x. During the last quarter of FY25, we also exited some portion of our stake to a few family offices, and at close to this valuation, and that's what is reflected in the increase in the valuation as well. From a business perspective as well, the company has grown by about 11% year on year on December 24 as compared to December 23. MPL has also seen a significant increase in valuation from 1.07 to 1.24. Again, MPL has been consistently profitable over the last 5 quarters. They've been profitable, and on a year-on-year basis, they've shown a 29% growth in revenue, and that's a reflection of the increase in valuation as well. Daily Hunt, we saw a drop in valuation from 1.25 to 1x. This is a factor of largely on account of reduction in the multiples, moderation in the multiples, and that's the factor. There have been certain changes in the accounting policy that Daily Hunt is following, and we'll go into more details as we get into the portfolio companies. But a combination of these two have led to a drop in valuation in daily. Licious, a small increase in valuation consistent with the improvement in revenues as well as the reduction in burn that Licious has been consistently showing over the last few quarters. And therefore, there's been a small increase in valuation in Licious. PharmEasy, this last year was an off year for PharmEasy where we were expecting improvement in the profitability, both growth as well as improvement in profitability in PharmEasy, and they fell short of their business plan and AOPs. And therefore, we have reduced the valuation to about 0.23x. This number is very close to the last round valuation that they had done at about 4.84 rupees per share. This is very close to that number. And we've been conservative and brought it down to that, very close to that sort of valuation. So now overall, the unlisted portfolio stands at about 1.19x. This slide now covers both the unlisted as well as the two companies which we have in our portfolio which are listed, which is Swiggy and TBO Tech. Swiggy has seen some volatility in the share price where it improvement in share price post listing to include more than 600 rupees per share, at which point we had exited some portion of our holdings, and post that there have been corrections in line with the competitor. The Swiggy also corrected, and we'll go into the more details of Swiggy and how the performance has been. So therefore, we've seen a drop in valuation of Swiggy to about 0.88x. TBO Tech, solid performance as well as on the company's stock price performance has also improved. Now it's trading at 1.22x from the time it listed and the time that we acquired these shares. So overall, including the unlisted portfolio, we are at about 1.16x. This slide covers the overall valuation of the the exited portfolio. For the exited portfolio, we've exited about 61 crores worth of capital at about 101 crores and realized about 101 crores, which is 1.64x on the overall realized one, and grand total comes to about 1.18x. The next few slides, we'll talk about how the markets have done both on the unlisted as well as from the investment side as well as from the exit perspective. The Q1 25 numbers, we've seen our investment about $14 billion in line with what it was in the last quarter. Still not the peak that we've sort of seen in the first half of last year, but still a momentum that is picking up and expected to continue. That momentum is expected to continue in the next few quarters as well. Most of the capital has gone into growth and startup and early stage investments, followed by the buyout stage as well. And that trend has not changed meaningfully over the last few quarters as well. From the exits perspective, though the overall level of exits at $8 billion is higher than the last quarter, but bulk of that exit has actually come from the infrastructure side. On the PEVC side, which is what is relevant for us, we've seen a slowdown in the exit, and this is actually one of the lowest numbers that we've seen over the last 7-8 quarters. This is a reflection of both the capital market activity as well as secondary sales happening in the market today. We don't see too much of that improvement. Capital market activity depends on how the markets improve over the next few quarters, but we expect that this will revert back to maybe close to the $5 billion mark in the next few quarters. But we're not expecting a big jump up in the values over the next few quarters. Last slide. On the macro front, because of the tariff issues that on account of what happened in the US, the impact was seen across the globe, and most of the economists have started bringing down the growth estimates for various large economies, including India. The full impact we'll get to know once the entire tariff discussion negotiations are completed. US stock market has also seen a flat year in CY25. Similarly, for us as well, we've been last April was a better month for the Indian stock market, but overall it's been a muted performance, and that may continue for the next few quarters as well. And similarly, the IPO activity, though the number of DRHPs and filings have continued, however, the overall number of IPOs that will actually open up may remain muted and may pick up only in the second half of this year. Now we get into the portfolio companies, and we'll take you through each of our companies, starting with NSE. NSE has had a solid year, 16% overall growth. This is, though it was lower than what it was last year, largely on account of Q4 CY25, where we saw a decline in revenues of 13% decline in revenues because of SEBI's newer restrictions, newer regulations to try and curb the overall derivative, especially the option volumes. The impact of that is already seen in the volumes, where we're seeing option volumes actually reducing by close to 30%. The entire 30% drop in volumes is not translated into 30% drop in revenues. It's only been 13-14% drop in volumes. The full impact will be seen in the FY26, and we'll keenly await the numbers for the next few quarters. The company has declared a dividend of 35 rupees, which is higher than what it usually does, which translates to about 5.6% dividend yield on our entry price. This higher dividend is on account of certain one-time divestments that they had done last year, and therefore they are rewarding the shareholders by paying out that amount as well back to the investors. Currently, we are holding this investment at about 2.3x of our invested value, which is roughly close to about 1,400 to 1,500 rupees per share price, as compared to our entry price about 620 rupees. Pine Labs, here the numbers are a bit dated. This is for the last numbers that are available with us as the September quarter numbers. This is because the company is on the verge of filing their DRHP expected in the month of June, and therefore they are in the silent period, and they will then disclose only post the DRHP filing. They will disclose the numbers that they're filed with. As we've discussed it in the past, they've appointed Axis, Citi, JP Morgan, Jefferies, and Morgan Stanley for the IPO, and by June 25 they will file it. But based on the first half numbers, they seem to be on track to deliver nearly 100% growth, year-on-year growth in the EBITDA numbers, and that with that strong performance, I think they should have a good listing once they hit the market, expected in the second half, closer to Q3 end or Q4 start is when the IPO is expected to hit the market. Sorry, here, as I mentioned earlier, we are valuing the company at about 1.6x of our investor, as compared to 1.38x in the last time we had valued Pine Labs. SMT, Sarjanand Medical, one of the largest players in the cardiac stent market. Here as well, the company is in the silent period, therefore we don't have the financials post December 24. The company till YTD December, the company had shown 11% growth and an improvement in the but the last quarter was expected to show an improvement in margins. We'll await those numbers once the DRHP is filed. The company is on track to file the DRHP again in the month of June. Here we had exited some portion as part of the pre-IPO round to a few HNI investors, some portion, which has already been distributed to our investors. We will continue to try and monetize more of our stake, and once the DRHP is filed, we'll try and liquidate more of our stake over the next few quarters prior to the IPO. PharmEasy, one of the largest health tech platforms that we have in India across B2C retail sales of pharmacy, B2B sales to hospital, as well as distribution of pharmaceutical products, as well as in the diagnostic space through the acquisition of Thyrocare. Now, these three businesses have had differing year, had different trajectories during this year. Thyrocare had a wonderful year. They grew about 20% year on year, one of the best performing diagnostic players in the country today. and that is reflected in the numbers. However, it's followed by the B2C business, which was the company has grown the B2C business in the last 9 months. However, the B2B business is where the company has taken certain corrective actions on and given up a lot of the loss-making businesses, because of which the overall revenues have grown only by about 2%, and the profitability has also been impacted because they've taken certain provisions and losses on account of the B2B business, and therefore the EBITDA is also impacted. Culmination of all of these factors is why we brought down the valuation for PharmEasy from 0.4x to about 0.23x, bringing it closer to the rights issue price that they did at about 4.84 rupees per share. The expectation is for PharmEasy is that they will start to show growth starting in the new financial year, but we'll wait and see how that pans out in the next few quarters.
Mobile Premier League, this is a gaming company. The company has had a phenomenal year. FY25, not only they grew by around 30%, they also had 5 running quarters of profitability and good profitability, 11% EBITDA margin. They had a $16 million EBITDA compared to negative $1.4 million of EBITDA last year. They in fact beat their annual operating plan as well. They haven't got any GST notice as well as of now. The company was, as a result, the third-party valuer has also marked it up from last year 1.07 to 1.24 times. Interestingly, true to its mandate for diversifying and being a platform, they are diversifying across revenue channels. Today, 30% of the revenue comes from Europe, and which is growing very fast. The Europe business itself is growing at about 60% YOY, and it is expected to continue. They're going to expand in America as well as the South American markets as well. The company overall is very well funded, has about $45 million of cash, and anyway it is profitable, so it's in good stead right now. We look to exit this in calendar year 2026. Going on to Daily Hunt. Daily Hunt, the company in FY25 grew well organically at 30% and inorganically, in counting the acquisitions that they made at about together, they grew by 85%, and they also reduced their burn. However, since Deloitte conducted an extensive audit exercise as their tenure was ending, and they were passing the baton to PwC. In this audit exercise, they realigned some of the gross revenue items to net revenue. As a result, because of the revenue changes, while there was no impact on the EBITDA. Because of these revenue changes, there was a change in the multiple. A moderated multiple led to a reduction in the valuation by the third-party valuer. As you can see, last year we had marked it to 1.25x, and today we have marked it to 1x. The company is working towards breaking even in a couple of quarters. You would have read as well. They're looking at some reductions in the cost side very, very aggressively, as well as continuing on its growth path. Again, this company we will look to exit in calendar year 2026. Licious, after a slow FY24, FY25 was a time when they picked up their growth journey. They grew organically by 15%, and with an acquisition in the offline side, they grew altogether by 18%. At the same time, there was a reduction in burn. They have achieved a 30%, almost 30% gross margin levels as well. So doing very well in terms of the way they are cutting down their burn, which is sustainable by bringing in efficiencies at various levels, and also continuing their growth journey. The offline expansion is tracking very well. They have expanded into 4 stores in Bangalore. and will be expanding further. There are aggressive expansion plans for FY26. My Chicken and More acquisition, which is a Bangalore-based offline company, gives them an additional footprint of 27 stores. This is a profitable company that they acquired. The company is well funded, and again, we will look to exit this in calendar year 2026. Now coming to our listed investments, again, when it comes to Swiggy, the food delivery company, the food delivery business vertical grew very well. In fact, at some point it has even beaten Zomato in terms of its margins, as well as the beating the expectations of the analyst in food delivery. They're already at about 2.9% EBITDA as a percentage of GOV, compared to the market expectation being 2.6%. On the other hand, quick commerce, because of the competitive intensity, saw an expanded burn, and also, so this was on account of putting down more stores, about 1,000 stores from 700 odd stores in the previous quarter. While the company grew 20% quarter on quarter and 100% YOY, but because of these expansion in the store, in the newer geography, more incentives because of competitive intensity, there was a reduction in the EBITDA margins. Having said that, company has pointed out that this is the peak of the capex cycle, and most of the capex being done. They expect they should decline going forward, and the company is very well funded with about 6,600 crores of cash. Interestingly, the stock is valued currently largely hinging on the food delivery. There is hardly any valuation given to the quick commerce business, which means that it is very, very undervalued. And we will, as we have already pointed out a couple of calls earlier as well, that we will exit at a time when we think the valuation is right. We have a certain number which we are tracking for this exit. In terms of TBO Tech, the results are actually coming tomorrow, so we have not updated it. These are 9-month number. But I think one interesting thing we want to point out in terms of TBO, if you can just move to the next slide. TBO Tech as a platform, because of its uniqueness and the growth it has established and the ROCEs that they have, consistently high ROCE, very high promoter shareholding, which gives a lot of steer in the company. The company has continued to be performing well, although they have come off because the overall market itself has been muted and depressed. The company has come off from its highs, but interestingly, if you go on to the next slide, the institutions are stacking up on the company. If you refer to the chart on the right side, the mutual funds, which used to own 3.4% as of the listing date, they have gone to 14.6% shareholding of the company. They're loading up on the stock, some of the large funds, and this is largely because if you see the growth that the company delivers compared to its peers, the ROC the company has compared to its peers. I mean, the revenue growth, the EBITDA margins, this is a company which is, kind of ticking a lot of boxes, and in a space where, in a TAM, which is global TAM, and a TAM which has a lot of tailwinds in terms of, the travel, etc. And that is the reason why at this stock price, there have been a lot of buyers. Again, we don't want to sell at a depressed stock price, especially when the market is also depressed. We have a certain stock price in mind, and we will exit it at the right time. Yeah, that brings us to Aadhaar. Aadhaar we recently exited. I mean, we just wanted to cover the stock. Given we have fully exited, we had invested about 10 crores, and we made about 1.46x on this company, and we've returned the capital as well. The company got a good tailwinds with the affordable housing finance and the repo rate cuts. announced in the budget and in February as well as recently. So the stock has been doing well, and we took a chance. I mean, we realized that the company is well valued and we should take an exit, and hence we have exited true to our mandate. Yeah, that brings us to the end of our commentary on which we wanted to give on our portfolio. Happy to take questions on when is the plan for NSE IPO.
So NSE IPO is a difficult question because though company has made all the right moves of applying to SEBI for clearance, because SEBI is the regulator for NSE, they applied to SEBI last year. SEBI came up with a few questions to the company, which the company promptly reverted in February. But post that, there's not been much communication, so we are not sure when the IPO is likely to happen. Could be sometime next year, but that is speculation at this point of time. From an exit perspective, the liquidity on the counter is fairly high, and therefore, even if the IPO were not to happen next year, we believe that we'll be able to exit out quickly in the secondary market to other financial investors, and therefore we are pegging our exit only in the next sometime in the next calendar year.
Dheeraj, questions on Farmeasy future roadmap and exit plan.
So Farmeasy, from roadmap perspective, the company is expected to start showing growth from this quarter, which is the Q1 quarter. And this full year is expected to be growth and coupled with profitability. The management team is working towards that. And the company is also working towards potentially a combination of primary and secondary rounds in sometime during this calendar year. We'll work towards an exit along with the company, and then, but in our estimate, we are taking Farmeasy will be an exit in CY26 timeframe.
There are questions on the exit plan from Swiggy. Swiggy, as I said, see, it's a liquid stock, but it is fairly undervalued, given being the business is at around around 75,000 crores of valuation, which is largely the food delivery valuation. Quick commerce valuation will be like some while it will be like some $46 million odd or something. So it's very, very small. There are several reports out there. We'll be happy to share that with you. So when the Swiggy becomes fairly valued, and we think that there is no more incremental returns, from there, we will exit. We actually have a certain share price in mind, and we are tracking that share price, and we will exit as soon as the share price hits. We are actively tracking it with our broker. Exit opportunity in Licious. See, Licious, the company is growing well. The way it is tracking, even the offline piece is picking up. We would like to see a lot more offline, juice to kick in, the goodness to kick in from the offline piece. And the company can then be valued much better. Having said that, anyway, calendar 2026 is when we will exit the company. So we will start working on the exit soon. What will happen if we are unable to exit problem stocks, and for how long can you extend the fund, Dheeraj?
From what we are planning, we still have about 20 months left till the end of fund life without any extensions. The extensions, as per the fund documents, is +1, which is usual standards, but those extensions are subject to investor consent. The way we are working on is to look at an exit without counting on the extensions. We will actively look at exits from all portfolio companies in the next calendar year, and for that we are already in discussions with the company as well as with other participants who can potentially look at these. But we will take a call on those closer to the end of this calendar year and early next year on those few companies which may not find an IPO exit. we will look at secondary sale for those assets in the next calendar year, but we are not counting on the fund extensions for liquidating these assets.
Yeah, I mean, just drawing on to the questions on since 1.5 years are left for the exit. Either we will sell it to another fund as a secondary strategy, and we will not wait for the IPO time frame, if that answers your question. Then, yeah, there is a question on Daily Hunt issue. As I said that, see, Daily Hunt, the issue was there was a company which was also their client and also a vendor to them. So the revenue that they were earning was booked in the revenues, and the expenses that they were incurring because of them providing some services as a vendor was booked in the expenses. So the EBITDA was arrived at using that. What the auditor said that since the same company is giving revenue as well as expenses, you should take net revenue, and that is why that had to be accounted for, and that was the change which has happened. It is very well covered in their audit reports, which are available on our ROC and MCA website. So, and that's what Deloitte has covered. Yeah.
More than the issue, it was a difference of opinion on how the revenue should be recognized and what is the correct methodology, which is where the company took some more time to come to a conclusion. And they've taken that in their FY24 accounts.
View on PharmEasy.
So as I mentioned, the PharmEasy, it has been issue with, we expected that growth would have come back in the second half of FY25, but that was not the case. We still don't know the Q4 numbers as yet, but as per the management, when we spoke to them a couple of weeks back, was that the growth will start kicking in from this from this quarter, Q1 quarter, and they want to be consistently profitable from here onwards and keep increasing on that profitability. The management is trying to work on a plan where they can raise some capital, though they don't need that capital, but they will try and raise some capital one is to benchmark the valuation, and then on the path to an IPO possibly next year. These are management comments. We'll work with them to ensure if we're able to catch that window. We are also waiting and seeing if the growth translates, if the commentary translates into actual growth in FY26. A lot of the corrective actions have been taken in FY25, and therefore we are more optimistic that the growth across these levers. So the three lines of business, which is your diagnostics, the B2C, and the B2B business. The B2B business was the one that was dragging them down because of which they've taken a lot of corrective measures last year. The B2C business have already started showing early double-digit growth, and similarly the diagnostic business, which is Thyrocare, which is showing 20% plus growth. With the B2B business corrected, we are more optimistic that overall business will start showing growth, and the profitability will also start kicking in from this year.
So, a couple of questions, Dheeraj, on which companies will be the companies that you will exit in the pipeline immediately,
Yeah.
And when can we hit about a 1x DPI?
Okay. On the exit pipeline, we have two companies which will file for DRHP shortly. So we have, okay, let me just recap. We have about 9 companies in our portfolio, of which Swiggy and TBO Tech both listed. We have certain price bands in mind. We are very hopeful that they should, I mean, depending on where the markets are, over the next quarter or so, both of them will hit, next few quarters, both of them will hit their price targets, and we'll try and exit out over the next 2 quarters. Out of the balance 7 unlisted ones, we have Pine Labs and SMT, both will file their DRHP by June of 2025, and hopefully will hit the market before Diwali of this year. And we will try and exit out from them shortly thereafter, both these companies. So CY calendar, we envisage exits from 4 companies at least: Pine Labs, SMT, Swiggy, and TBO Tech. NSE, as I earlier mentioned, is a fairly liquid counter. Though we are not gunning for an exit in this calendar year, we will look at an exit in the next calendar year. The balance four companies, though the companies have said that they will either do a round or work towards an IPO. We are working with the company. We're in discussions with them constantly to find an exit for ourselves. Again, the other four companies will also see exits in CY26 timeframe, not in CY25. In CY25, we are expecting four, which is Pine Labs, SMT, Swiggy, and TBO Tech, NSG, and the other four companies in CY26.
There are questions on Swiggy valuation rationale. So let's break it down. Currently valuation of Zomato on EV EBITDA basis of 41 times their EBITDA. They are valued at roughly about 12-24 billion rupees. When it comes to Swiggy, with the same multiple applied, they will be valued at 765 billion rupees. As per current market price, that's what they're actually valued at is only 700 billion rupees. That is the food delivery part, which, by the way, Swiggy is in very, very close. Swiggy did about 1,600 crores of revenue in this quarter, and Zomato did about 2,000 crores. And in fact, Swiggy grew faster than Zomato in food delivery with improvement in take rates as well, and improvement in average order value as well. So the food delivery business for Swiggy is doing extremely well. Now, when it comes to quick commerce business, there is heightened competitive intensity. Zomato is being valued at roughly about various brokers you take is roughly 1.3 times their GMV. And this is talking about June 2027 GMV. This is not past one. And that will be valued at roughly about 1151 billion rupees. Swiggy currently, if we apply even 0.1x to the GMV, 0.1x, I'm not even giving 1.3x to what Zomato is giving to Blinkit. 0.1x, it is currently being valued at 46 billion rupees. That is 4,600 crores. Quick commerce business is generating a revenue of annual revenue of 22,000 22,522 billion rupees. So I think it's grossly undervalued. The quick commerce business has no value. Now there are whatever you can debate how much value you want to give to Zomato's Blinkit or how much value you want to give to Zepto, but there has to be some value given to Swiggy's Instamart business as well. It is a big part of the industry, and the revenue and the EBITDA it is generating, and hence we think, and even the street thinks, if you take any broker report, the target price is roughly anywhere between 450 odd rupees across brokers. We'll be happy to share certain reports with you if you want. And that's why we think Swiggy is fairly undervalued in today's thing. Market is anyway muted. The overall market is muted. With that, people are going towards safety stocks, the large caps, the safe stocks, and that is why some of these stocks are beaten down because of that, because of flight to safety. And the second, given the losses, markets love profitability. We had seen in Zomato also, the moment they kept showing negative quarters, and they just became profitable, and the price jumped. Same way in case of Swiggy, we expect that if they are able to achieve that profitability soon, like in food delivery business, they have been moving the needle quarter after quarter. In quick commerce, with the peak investment behind them, we expect that to move up. Happy to take any questions on Swiggy privately, because I think this will be otherwise just a one-stop conversation. There are questions on what are your targets for Swiggy. I mean, we are not allowed to tell our share price, otherwise it will be front running. So that's for compliance reasons. I think you answered this question, but Dheeraj, for the sake of repetition, at the risk of repetition, when is the NSE IPO expected, and what is, in case IPO gets delayed, when will we exit?
I think I covered that. The company has applied to SEBI to grant approval. There have been certain communications back and forth between the regulator and NSE, which NSE has reverted on. At this point of time, the company is geared up. The company has done what it can. It is up to the regulator to grant that approval. Furthermore, what the company has also done is reduce the compliance issues of or the time taken for NSE to approve any shareholder transaction, which was 3 to 6 months when we had actually acquired the shares. It is now dropped to less than a month now. Therefore, a lot of the friction of trading on the shares has also reduced. The company has done what it can. From a timeline perspective, the company is waiting for reverts from SEBI at this point. It could happen sometime next calendar year, but not sure. On how we will look at exit is, as I said, it's a fairly liquid counter with active investor interest at different price points all through this year, as well as our expectation is that will continue. And we will exit out to another financial investor who will want to come in at that point of time. We don't see a challenge in exiting NSE at all, but we're just holding on in the expectation, in the hope that the IPO is actually closer in CY26 and then see a bump up in valuations on account.
Okay. As there are no further questions, thank you so much for participating. For those who have missed, we will be circulating a summary as well as the recording of this webinar. Thank you so much.
Thank you.